This fourth presentation, the final presentation in the series on retail brokers. Now, previously we've looked at the concepts of stop hunting. We've looked at who the stop hunters are. It is definitely a concept, but it's not the brokers. So we talked about that in more detail. Then we looked at the intraday volatility and changing market conditions. Again, the frustration you feel as a retail trader if you're always getting stopped out, if it seems like every time you take a trade, the market moves against you. This concept was discussed by looking at why that happens and how you can, eliminate that by focusing on the news feeds. And then the last video we looked at, of course, was the concept of booking and how retail brokers do create a false trading environment for retail traders, but it's nothing underhand. It's perfectly legal. It's perfectly a normal everyday thing that pretty much every retail broker does. But ultimately, it does mean that all the money you lose does go to the broker's pockets rather than into the market. Now, the final concept is what happens to profitable traders. So, you all start off on a B book at a retail broker. That's where everyone starts their trading life. Now, then they get sifted into two categories. First of all, the losing traders, which are great. They just keep shoveling money into the broker's pockets. And then there's another smaller section, of course, the 5% or the 2% of profitable traders who actually start making consistent money. Now, at the beginning, these guys won't really concern the brokers too much. They won't really show up. But over time, if they start putting more money into their trading account and trading larger sizes, this is when the retail brokers will start to become a little bit concerned. And when we say size, I'm talking about, 20 or 30 lots, trading 20 or 30 lots before the broker starts getting really too aggravated and concerned. So, if you're trading mini lots, micro lots, the broker really doesn't care about you. Most retail traders are trading that size. The broker just doesn't care. There's no special algorithm or software watching each account. It will only be flagged up when the trader's trading significant amounts and making a consistent profit, which is basically costing the broker a significant amount of revenue and money from their own pockets. So, what does the broker do? Does the broker switch on some clever system to trade against the profitable trader? Does he try and move the price so it can somehow steal their money or anything along those lines? The answer, of course, is no. What the broker does is he simply moves that trader to something called the A book. And all the A book is basically when the trader places a trade, the broker just becomes a conduit. So there's no false environment anymore. The price is what the market price is. It's all exactly the same. And when you push that button, the trade goes through the broker straight into the market and either goes to one of two sources. It either goes to an ECN network or an STP, which is like a liquidity provider such as a bank. So what will happen to your order then is you'll click the buy or the sell order. And then if it's an STP, the bank will then decide whether they want to fill your order or not. They might only decide to fill partially fill the order, and so then you'll need another bank to fill the rest of it. In these instances, basically, this is where you get slippage because you can't fill quick enough at this exact price. Only, Bank A will only fill you at that price at a certain amount, and Bank B just hasn't got any liquidity at that price whatsoever. So you'll end up getting a slightly worse price with the STP method, but you are getting straight through to the market. You are getting 100% real trading conditions, which is actually often worse than the B book in a way, because at least the B book is kind of like guaranteed. You don't really get so much slippage and stuff like that, whereas the A book you tend to get a lot of slippage because it's natural environment. Now the ECN is a bit more reliable because ECN makes everyone a liquidity provider. So if you're selling something, there might be other traders, other retail traders who are buying that same thing. They'll all be aggregated together with the banks, with the liquidity providers. Everyone will be aggregated together, all the buyers and all the sellers, and they'll basically just transact off each other in that natural market environment. So you tend to get less slippage with an ECN, but ultimately, as you move up in size, the issue, slippage issue just is wherever you are. So whatever happens, you're going to get slippage, and it's going to be difficult. Now, generally, you don't really start to get too much trouble beyond around about 1 million or 2 million. So an individual bank will tend to fill 10, 20 lots or 30, between 10 and 30 lots, a single bank will fill. After that, they'll get a bit nervous and they'll want to kind of split it between another bank, and this is where you'll start to get the slippage come in. So slippage isn't going to be too much of a problem until you're trading a fair amount of size. Obviously, if you're trading around news events or something really volatile, yes, you're going to get more slippage then, just because there's less liquidity in the markets. But under normal trading conditions, this isn't going to be an issue until you're trading, much larger size. And even then, it's only going to be minor. So the profitable traders get basically moved to the A book, which is better market conditions, more natural market conditions, but it does get harder the larger your size gets to actually place trades and avoid that issue of slippage. But on the other hand, you're not going to get this issue where all your losses are not going into the broker's pockets, they're going into the market, and your gains are not coming from the broker's pockets, they're coming from the market. So once you're on the A book, the broker really doesn't care about you at all. It's forgot all about you, and the focus of the broker is on make sure its overall portfolio is balanced. So there's no software, there's no algorithms watching your account trying to take your pips. Once you're on the A book, you're considered a profitable trader, and then basically at the mercy of the markets. and you get exactly the same conditions as professional traders trading for, professional trading firms and funds, etc. So that's what happens to professional profitable traders. There's nothing, underhand or illegal going on. A lot of people do find it morally objectionable the way retail brokers work, but that's a completely different issue. But at least understanding that all the concepts of how it all works will help you understand maybe why you're getting so frustrated and why you seem to be getting stopped out so much and why you just can't seem to make a profit.